What if I told you that saving just 1,000 Kenya shillings a week could grow into over 1 million shillings without you working any extra hours? Sounds like magic? A scam? A lottery win? Nope. It's not a get-rich-quick scheme. It's better. It's the most powerful force in finance, and it's completely accessible to you right now. That's the power of compound interest, and today on Money Moves, we are breaking it down for you. You see, most people focus only on how much they earn at their job. They try to work harder, clock in more hours, or chase the next promotion. And that's fine. But it's the slow way to financial freedom. The fastest way to grow your wealth is to make your money work harder than you do.
Also, today on Mint, home insurance, safeguarding your haven and investments. Say cheese, being smart about the cost of a smile. How pitmasters are revolutionizing Nyama Choma.
Earn it, spend it, save, invest. Earn it, spend it, save, invest. Mola, kila siku niko chesa mola, make more bila stress. Mola, kila siku wesa mola, make more bila stress.
This week on Money Moves, we explore the concept of compound interest. Is it a key to building long-term wealth? A financial force that, when used wisely, can help grow substantial wealth over time?
Earn it, spend it, save, invest.
Today on Money Moves, we are answering a powerful question. How can just 1,000 shillings a week grow into 1 million? It sounds impossible, right? However, the secret lies in one of the most powerful forces in finance: compound interest. Compound interest is when the money you save doesn't just earn interest on the original amount, but also earns interest on the interest you've already made. It is like planting a tree which matures, bears fruit, and produces seeds. Each of these seeds grows into another tree, and soon you have a forest. Let's break it down with our 1,000 shillings a week example. That's about 4,000 shillings a month. Now, imagine putting this amount into an investment that earns an average of 10% per year. A realistic return if you invest your money in a mix of long-term stocks, unit trusts, or retirement funds. In the first year, you've saved about 48,000 shillings. With a 10% interest rate, this will grow to just over 52,000 shillings. Not too exciting yet, right? But here's the magic. Every year, your savings plus the interest you've earned start earning more interest. After 10 years, that 1,000 shillings a week could have grown to over 800,000 shillings. After 15 years, it could have increased to over 1.3 million shillings. And if you keep going, the numbers continue to compound upward. That's how 1,000 shillings a week quietly builds wealth over time. Let's say you started saving when your child was 1 year old. If you simply saved the cash under your mattress, after 15 years, you'd only have 720,000 shillings. However, with compound interest, that same money could have doubled and might cover much of their secondary school education. This is why Albert Einstein is often quoted as saying, "Compound interest is the eighth wonder of the world. He who understands it earns it, he who doesn't pays it." So here's the big takeaway. You don't need a lump sum to become a millionaire. What you need is consistency, time, and the power of compound interest. Start today. Whether it's 1,000 shillings, 500, or even less, make it a habit, because in the world of money, the earlier you start, the richer the forest you'll grow. That's your money move for this week. Stay smart, stay consistent, and let your money work for you.
Earn it, spend it, save, invest.
For most families, a home is more than just bricks and mortar. It's where memories are made and possessions are kept. Yet many only think about protecting it after a disaster strikes. A home insurance policy, often called a domestic package, is designed to shield homeowners and tenants from unexpected events such as floods, fires, theft, and damage. Today we explore what a domestic package covers, why it's crucial, and why uptake in Kenya remains low despite growing risks and a booming housing market.
For most families, a home is their biggest investment. Not just a building, but the memories and possessions inside. Yet, many only think about safeguarding it after something goes wrong. A home insurance policy, often called a domestic package, is designed to cushion homeowners and tenants from life's unexpected turns. So how does it actually work?
It's an insurance that people take to protect their homes and what they own in those homes.
The truth is that life is unpredictable. Disruptions can strike without warning, leaving people financially exposed.
Why is it important? Because of many eventualities, people do not anticipate that they are going to happen. Nobody knows when an accident is going to happen. Nobody knows where thugs will come and vandalize your home. Nobody knows that you live with your laptop and you may not come back with it back to the house. In Kenya, we never anticipated to have floods, especially in Nairobi, and people lost a lot of property in terms of even the context of the house.
In Kenya, insurance penetration remains at just 2.4% of GDP, well below the global average of 7%. Yet in 2024, premiums across the industry hit 395 billion Kenya shillings, showing both the size of the industry and the untapped potential, particularly in home insurance.
We are seeing people now embracing having a home insurance, something that you couldn't really talk to people about. They didn't see the need. But with the kind of natural calamities we are currently experiencing in the country, I think people are seeing the value of having a home insurance.
With more extreme weather events and a housing sector that continues to grow, the domestic package market has strong room for expansion. Industry watchers say even a 5 to 10% rise in uptake would add billions to the insurance sector.
We have very few Kenyans buying home insurance. And one assumption I think most of the homeowners make is that accidents do not happen to our homes. I'll say it's the ignorance of the importance of a home insurance.
For cover to be effective, honesty is the foundation. Every detail shared must reflect the actual situation on the ground.
There's something called utmost good faith in insurance, where we want to believe that the client is given the true information about his home.
So what does this protection actually extend to? It is broader than most realize.
Home insurance has 5 components. So number 1 is where you insure the building. Number 2 is where you insure the contents, what you do not move out with. And then number 3 is something we call all risk, that covers portable things that you move around with, the phones, the laptops, the cameras. And then we have the WIBA, and then we have owners and personal liabilities, and occupiers and personal liability.
Securing coverage begins with documenting the property and everything inside it.
Under the coverage of the building, we'll need the value of the house or the building and any structures within the compound. And then you'll be required to give us the location of where that building is. Under the contents, the client will be required to list for us everything in that house. That includes the furniture, the beds, the clothing, the jewelry, the electronics, the cutlery in the kitchen.
Naturally, cost varies from household to household, depending on what one chooses to include.
And it's up to an individual to choose how many components of the home insurance do you want to include in your cover. That will determine how much premiums you pay. So for someone living in an apartment, it's not like somebody who is living in their standalone house. We can do something we call insurance premium financing, where we have the bank paying the premiums on your behalf, and then you as a client, you can either do a standing order or direct debit, or even give post-dated checks to the bank, and then you'll be paid maybe in 3 or 4, 5 or 6 equal installments, depending with the arrangement that the insurance companies have with the bank, with the different banks.
Policies aren't static. They can and should evolve as the value of your home and belongings changes.
If you've actually added a few items and you'd want to insure them, upon renewal of the policy, it's good to indicate that during the renewal.
And when disaster does strike, the process to restore losses is straightforward.
It depends the extent of the damage and how soon even you as a customer provide us with the necessary information that we need, and then it requires us to come, send the assessors to come to your home and assess the damage. and they give a report.
Home insurance is not a luxury. It's a financial seatbelt. Insuring your space today could be the difference between starting over or simply carrying on after the storm.
Home insurance is as important as a medical insurance. Home insurance gives you protection that in the event an incident was to happen in your house, you're well protected. We take insurance to transfer that risk to an insurance company for a small fee. If you own a home, I would say it's almost mandatory to have a home insurance. If you do not own a home, it is very important to have insurance for the content you have in your house.
Your home is probably your most valuable asset, and a domestic package helps protect you and that investment in several ways. While it won't prevent damage to your home or belongings, it may provide a financial safety net if the unexpected occurs. Let's take a short break. We'll be right back.
Coming up, say cheese, the cost of a smile.
Earn it, spend it.